Today's economic landscape is being shaped by a convergence of global conflict, inflationary pressures, and domestic policy decisions, all of which are influencing both financial markets and everyday consumers. At the center of this environment is a sharp rise in oil prices, BKBVT, escalating tensions in the Middle East. Energy costs are a critical input across nearly every sector of the economy, and when they rise rapidly, they tend to push inflation higher. This creates an immediate challenge for policymakers who have been working to stabilize prices after several years of elevated inflation. Federal Reserve Chair Jerome Powell addressed these concerns by emphasizing that the U.S. economy remains fundamentally strong and resilient. Job growth has held steady, consumer spending has not collapsed, and key economic indicators continue to show underlying stability. However, Powell also acknowledged that the recent surge in oil prices introduces new uncertainty. While the Fed has made progress in controlling inflation, energy-driven price increases could slow or even reverse that progress if they persist. As a result, the Federal Reserve has chosen to maintain its current interest rate levels rather than begin cutting rates as some markets had anticipated earlier in the year. This decision reflects a cautious approach, as lowering rates too soon could reignite inflation. At the same time, keeping rates elevated for longer increases the risk of slowing economic growth. This tension has led to renewed concerns about stagflation, a scenario in which inflation remains high while economic expansion weakens, creating a difficult environment for both policymakers and consumers. One of the most immediate areas where high interest rates are being felt is the housing market. Mortgage rates, particularly the 30% year fixed rate hovering around 6.33%, continue to make homeownership less affordable for many Americans. Higher borrowing costs translate into significantly larger monthly payments, which has discouraged potential buyers from entering the market. This has led to a noticeable decline in mortgage applications and overall housing demand. The slowdown in housing activity carries broader economic implications. The housing sector is closely tied to construction, consumer spending, and financial services, meaning that reduced activity can ripple throughout the economy. While some forecasts suggest that mortgage rates may gradually decline later in 2026, current conditions remain restrictive, and affordability challenges continue to weigh heavily on both first-time buyers and those looking to upgrade or refinance their homes. At the same time that the Fed is maintaining tight monetary policy, U.S. financial regulators are moving to ease certain banking restrictions. Specifically, there is a proposal to reduce capital requirements for large banks, allowing them to hold slightly less in reserve. The goal of this policy shift is to encourage banks to increase lending to businesses and consumers, which could help stimulate economic activity and offset some of the drag caused by high interest rates. However, this regulatory easing is not without controversy. Supporters argue that it will improve liquidity and support growth during a period of uncertainty, while critics warn that lowering capital buffers could increase the risk of financial instability in the future. Together, these developments highlight the delicate balancing act facing policymakers: managing inflation without stifling growth, supporting lending without increasing systemic risk, and navigating a global environment that continues to introduce new economic challenges.
Question: why didn't you tell US allies in Europe and Asia, like Japan, about the war before attacking Iran?
So we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Why didn't you tell me about Pearl Harbor? No, you believe in surprise, I think much more so than us.